In this video, John talks about identifying markets that are overbought and oversold. Are momentum indicators like RSI really worth using? And if not, how to use technical analysis and market behavior to create your own opinion. This is a good one. Listen up. For those serious about becoming successful, consistently profitable options traders, now is the time to build skills in technical analysis, market analysis, and applied volatility to get those results. We have multiple memberships, starting with our Go membership that teaches rules-based trading and our Pro membership that teaches more subjective trading. For more information, go to lockeinyoursuccess.com/memberships.
The presentation is for educational purposes only. We're not broker deals or financial advisors and not making any specific trade recommendations. Also, please be aware the risk in trading options is substantial, and please make sure you're aware of all your risks prior to placing any trades. Also note that any trades and/or results in this presentation, please consider them to be hypothetical computer simulated trades and results. I believe to be as accurately represented as possible. Keep in mind live results can vary from simulated results for many different reasons. So you have a question in the forum. So let's take a look at that first. And it is, could I please explain how you determine the market is overbought or oversold? I notice that you do not use an RSI indicator on your charts. Alternatively, do you simply determine market overextension based on whether the market has exceeded profit, like price pattern targets? I'm seeking opportunistic entries for a super bear trade, for which I've been outright wrong on the two recent trades using RSI in addition to TA. So a couple comments first. Determining whether the market is overextended is dependent on many situational factors that are different each time. So I'm going to break things down, or talk about a few things and break things down to see if we can start to gain a better understanding of that. And also, just talking about RSI indicators and indicators in general. Before you use or employ any indicator, you want to decide whether or not that indicator is even useful in the context of what you're doing. In other words, how often in the past has an RSI indicator been any sort of an accurate indication of whether the market's going to fall or not? And we're going to find these types of things, and this is true with any indicator and even like moving averages and stuff like that. One of the things you want to start to understand is how your asset trades. And I would say an RSI indicator might be useful on some assets in some time frames under some situations, but on the SPX, it's, in my opinion, it's little value. What does the RSI indicator indicate? It indicates that the market is going up faster at a faster rate than it normally does. It gets over certain levels, this is faster than it normally goes up 70% of the time. And I would argue we know that. Like if you understand your asset and you've normally been trading the SPX, you know it's gone up more than it normally does. And you know it's going up faster than it normally does. I mean, it doesn't take an indicator to figure that out. And one of the things about traders a lot of times, and as they're developing as traders, is you take a look at an indicator and you try to use that as a signal without understanding the indicator or what it is or how it does or what it means. It's kind of like I can add with a calculator, but if I never learned how to add, then I don't understand whether the calculator is being useful for me or not. Right? I mean, we see this all the time now in restaurants or stores or something. You go into somebody and if you give them cash and you need change, they look at you like you got three heads if they can't put it in the computer. They can't do simple addition, right? If you can't do simple addition, you don't know if you put 10 plus 46 in the calculator minus 3, and it's wrong. Like I would. If it comes out with 106, I know it's wrong because I know how to add, I know how to subtract. But it's somebody who doesn't know how to add and subtract. They would have no idea that it's not useful at that point, right? Or it's wrong because they punched in the wrong number or the machine screwed up or something. what is the RSI? I talked about what the RSI indicator is. It just tells you it's basically a momentum indicator. And you can go back in here, and you can go back in the past. You say, well, how often is RSI even useful? Here it tells me nothing. Here it tells me nothing. We didn't drop till RSI already dropped out. Here, yes, minor pullback. Yes, minor pullback. But what you're going to find is it's kind of random on whether it's useful or not. Like all in here, we had all this period of time where it's way, way overextended for a long time, and there's no pullback in sight there. And then it pulls back or actually goes up when it's kind of overextended. So the thing is, if you go and you look at all the instances with the RSI, you're going to find it's pretty much random on whether it means anything or not in isolation. So to me, and this is work that you can do on your own. To me, the RSI indicator in this time frame, the SPX, is not very meaningful. You can look in other time frames to see if it's very meaningful. The other thing you can do too, like if you're going to use RSI, is look at other time frames. Like if I go into the weekly, for example, I look at my weekly RSI indicator. Yeah, I mean, look how long it was overextended before it dropped in 2020, and really the only reason the market dropped was because of COVID, right? Look how overextended it was in here for a long period of time. It really didn't do anything for a period. And like I said, it's got limited usefulness. But one of the things that I do find interesting, or one of the ways you could look at it, is when we talk about who's in control of the market. RSI tends to be more useful on shorter term time frames when the market's trading based on or when the primary drivers of the market are short-term traders. The RSI in the short-term time frames is useless when the drivers of the market are institutional buyers. Institutional buyers have long-term outlooks, and they have long-term outlooks. And if you're looking at the long term, like on a weekly chart, RSI isn't even remotely high yet, right? And then on the daily time frame or whatever, you got to find if it's useful. Now, Mark comes out with, or is making a comment here. RSI is probably most helpful when it shows divergence at a low. Okay, yeah. Market makes new low, but RSI doesn't, right? So that's that's not using an RSI in isolation, right? So you're saying that, hey, the market's making new lows, the RSI is not making new lows, which is basically telling you that downward momentum's slowing down. Yeah, I mean, if it's overbought and the downward momentum's slowing down, then you can use it in that context. We can also use it in combination, as Lee said, with price pattern targets and so forth. But you want to see if it's useful at all in the context under which you're using it. And it's almost like back testing and going and back testing and seeing if it is useful. I would caution you, though, that, and this is particularly notorious with indicators, is the way people come up with indicators and create signals is they quote unquote back test the indicator. They come in and they do just what I just said. Is there a point in this indicator and on this time frame in this asset where it consistently goes over this level, or fairly consistently goes over this level, and then hits a certain point, and then the market almost always sells off? I would say if you go through this and you do this with this particular indicator, I would say no, there really isn't. But what they'll do is they'll set that level and they'll use that as an indicator, which is all fine and good, except those correlations don't always play out over time. Changes come into the marketplace, things happen, and they're no longer valid. There are much better ways to deal with it. That said, if you're having good luck with an RSI indicator and you're using it with some sort of divergence and it's working for you, that's great. Keeping in mind that it may not always work going into the future, but if that's working for you, that's wonderful, right? So keep using it, but you want to, before you start using any indicator, you want to see what's going on. I mean, I don't know what's going on like in an hourly time frame here with the RSI. Look how long this was oversold. Even in the longer term time frame, you can look how long this was up here, and it really didn't mean anything. But that's my personal take on that. And again, if you find the indicator useful, I don't want to discount that. But on the other hand, if you're thinking about using something, I wouldn't do that. Now, when we start talking about overextensions, that's a different story than a momentum indicator. ideally we do want to see, like, if we're going to go short the market, ideally we do want to see the market come fairly quickly into a significant resistance area and pull back. That's where it's likely to pull back. So I'm with you there. But one of the things you want to do is like I said, who is in control of the marketplace? And you can tell who's in control of the marketplace once a move is kind of underway based on how it's reacting to our shorter term price pattern targets. So if I come into let me pull this out for a minute. If I come into, say, this range here, and I look at what happened, is basically we have a cup and handle pattern here that broke out. You can see that, let's see, here's our primary point, okay? And I say that because we had a consolidation here, we consolidated here, when we finally broke out, we retested here. This is our most significant point. I expect this to go to price pattern target and back off. It blew through price pattern target pretty much. Okay, fine. We have our next level that comes into play here. So what's going to happen here is, normally, like on a normal technical market that's not coming off of a bottom or not moving overly fast, a lot of times you can take the move from the cup, right? So I can take my pullback, breakout, and a lot of times, if it's moving really technical, what will tend to happen is the market will come up into here, and then it'll back off and it'll go higher. It didn't do that. It jumped right over it. And as a matter of fact, it jumped to 2 times that level, and it even jumped over that. And it jumped to 3 times that level, and it even jumped over that. So my short-term traders have no control over the market. They're not selling it off. If they try to take short positions, they're getting killed, right? So this is just clear evidence that it's the long-term institutions and stuff are driving it. The short-term traders are not. They have no say in this market right now as far as direction. Let me pull this out. And even if I take my bigger price pattern here, this kind of played out fairly normally. But if I take this here, but it did overextend a little bit, right? So we came up really hard. Now you can see this here is getting into some more significant levels. Okay, so for the long-term player, this is not a level. For the long-term player, this is not a level. For the long-term player, this is the more significant level. You can see they kind of played off of that. When we broke out of that level, again, did it break out with long-term involvement or institutional involvement? Yeah, we bounced over our target. Did we do more than twice our target? Well, we kind of slowed down. So now it's, as you can see, the institutional involvement now is starting to slow out of this, okay? Because now I went twice price pattern target instead of 3 times, and it kind of settled out. And now our newest price pattern target we have here, and we did price pattern target, and we kind of settled out. So you can see that things are starting to slow down now on that time frame. Now, this would be like if I was doing, Mark said that, in a down move when RSI is overextended, what you're going to find when RSI gets overextended in the down move and the RSI starts to drop off, that's the momentum's dropping off. You'll see this to the opposite effect, to the downside, which starts to become a reversal signal, assuming we're overextended in the longer term.